Here is part 2 of our Chapter 5 video lecture. We left off talking about the purchases of merchandise. Now here, in part 2 of the video lecture, we're looking at the sale of the merchandise. In our example of this invoice we saw, we were looking at the viewpoint of the buyer, Sock Stereo, in the last video. Now here in the second video, we're looking at PD Audio, the seller of this same merchandise. So this invoice is now a sales invoice. Okay, sales invoice. And whenever you have a sale, there's going to be two journal entries the seller has to record. In the case of the buyer, the purchaser, they only had to record one when they bought the merchandise. The first one is to record revenue for the seller, and the second journal entry is to record the cost or the expense for the seller. So in this chapter 5, the revenue account we're learning for a merchandising company is called sales, or sometimes you can use the term sales revenue being credited. Like we learned debits and credits, sales is increased with a credit. Whatever dollar amount is now has to be debited to another account. And as we learn, whenever you have revenue, you either are going to debit cash asset, making it bigger, if it's a cash sale where you collect the money at the same time you make the sale, or if you bill your customer and can collect later on, then the asset you're debiting is the accounts receivable, and you're going to collect the receivable and turn it into cash maybe next month. Now the second journal entry to record for the seller is the cost or the expense of this sale. You do not deduct what you buy at the time you buy it. A merchandiser deducts what they buy, deducts the cost, expense the cost, at the time they sell it. So if one of the rules we're learning is to match up related expenses, revenue with the related expenses. So both of these are recorded at the same time. Here the credit is reducing the merchandise inventory that we're selling. So you gotta reduce that asset because you no longer have it. Assets are reduced with credits. The offsetting debit dollars goes to this new expense account called cost of goods sold. So this is what we had to pay for the merchandise we're selling to our customer. And the sales price or the revenue is what the customer is going to pay us for that same merchandise. So the difference between these two amounts is the gross profit we made on this one sale. So back to our example where PD Audio on May 4th is selling to Sock, our customer, $3,800 of merchandise on account. In other words, not a cash sale. So we debit the accounts receivable because we're waiting to collect the money, and the account being credited is our new revenue account called sales. So that's the first of two entries the seller has to record when we make a sale. The second not closing entry, but the second transaction we have to record at the same time is the cost of the sale. And the new cost of the new expense account we're learning here in chapter 5 is the cost of goods sold. So this is our big expense. Here's what the customer's cost is, and here's our costs. And the profit we're making on this one sale, on this one sales invoice, is $1,400. Now the offsetting debit to this credit, we gotta reduce the inventory we have in stock. Inventory is an asset. Assets are reduced with credits. Now we saw back in the previous video, Sock had returned $300 worth of merchandise. So now the seller has to record receiving back that merchandise. And again, if you remember back here when we made the sale, there was two entries. Likewise, when there's a return or an allowance for the sale from the viewpoint of the seller, there is going to be two journal entries. So again, the viewpoint of the seller, PD Audio, is getting back $300 worth of merchandise it sold. Now that's the sales price. We're given the amount of the cost of this same merchandise to us, the seller, PD Audio. So likewise, there's going to be 2 transactions to record for this one event. The first one is to record the amount of the $300 no longer collectible. So we're not going to reduce the revenue sales account, which would seem logical to do. We want to keep that revenue at the original amount. Instead, we're going to set up a new account called Sales Returns and Allowances. We saw the returns is when the customer returns merchandise to the seller, and an allowance is when the customer keeps that merchandise, but we reduce the price. We give the customer an allowance. Both go into this account here, and because it's the opposite of a sales account, sometimes we call this a contra revenue. Sales is revenue. Sales returns and allowance is a contra revenue. Revenue was recorded with credits to make it bigger, but contra revenue accounts are recorded like here with a debit. And the offsetting credit for $300 is the reduction of the receivable asset that we're no longer going to collect in the amount of $300. The second half of the journal entry for this return is to record the cost of the item being returned. And here again we're giving it to be $140 debit and credit. The amount being debited is going to go into the asset account that tracks the cost of the merchandise. And of course we know that's our merchandise inventory asset here being increased with putting back $140 of costs. And the offsetting credit is what we had debited before. Remember the cost of goods sold expense, now we're making it smaller with a credit. Okay, so 2 journal entries when there's a sale, or in this case a sales return and allowance transaction. In the okay, so here remember that inventory had cost us $140, but because we're assuming it's defective, it's not really worth $140 to us anymore when it's returned and put back into inventory. Here we're going to put it back at the lower scrap value. So we still record the reduction of the sales price of $300, sales returns allowance, debit, accounts receivable, credit. But instead of putting $140 back into inventory, we're going to put back $50, the value, the scrap value of that merchandise. And the offsetting credit is going to be again that cost of goods sold, reducing that expense. Okay, so we just saw the sales return and allowance account, a contra revenue, as compared to the revenue account. There's going to be another contra revenue account called sales discounts. If you remember, in the case of our customer, we're giving them a 2% discount if they pay off the bill within 10 days of the sales date. Well, that discount is not going to directly reduce sales. We're going to reduce it by putting it into first a contra revenue account, and then eventually offset the sales with this sales returns and allowance and sales discount. We always want to track these accounts here because this can be rather expensive to us. If you bury it by reducing sales, you really don't know how much returns customer had given you and how much allowances you gave or discounts you gave. So if these amounts get rather big, that's something what you want to investigate. Maybe someone's taking advantage of a bad policy or even embezzling money from you. In our example, our customer Salk is going to pay off the bill early. The amount they owe us right now before the payment is $3,500. That's the original invoice price minus the return of $300 sales price. Okay, so 2% of this is going to be their discount if they pay us off by May 14th, the end of the 10-day discount period. So on May 14th, we're going to record the collecting of the money and the reduction of the receivable they owe us. So here's reducing the receivable asset with a credit. And the offsetting debit, of course, I know I'm going to debit cash because that's what we're collecting, increasing that asset. But we're not going to collect all 3,500. We're going to collect only 98% of this because we're giving our customer a 2% sales discount. Remember, we're the seller. From our viewpoint, this is a sales discount. And as we've seen, there is a new account called that keeps track of the sales discounts. Contra revenue. Revenue was recorded with a credit. Sales discounts, contra revenue, recorded with a debit. And then the remaining debit, of course, is to our main account we want to see get bigger and bigger, and that's the cash. Again, this is 98. Sorry, I'm losing my pen here. 98. Bring up my pen. 98% of this 100% amount, and the discount is 2%. So total debits here, 100% equals the total credits of 100%. Now all of this sales and cost of sales are showing up on our income statement. And there's two variations of income statements for a merchandising company. The simple one is called single step, and the easiest way to discuss it is just to show you one. So here for Walmart, just two parts. The first part is revenue, all the ways of making money, and the second part, all the ways of using up money or costs, including that cost of goods sold account we just talked about. And the difference between the revenue and expenses is equal to our net income. But we want to have a little bit more numbers on our income statement because we want to analyze this in more detail. So besides the single step income statement, we now have a multi-step income statement. This would be comparable to the balance sheet where we have a so-called classified, remember all of those different groupings on the balance sheet, on a classified balance sheet versus a regular balance sheet. So this multi-step income statement will group the net sales and the cost of goods together to get that gross profit figure we've been talking about. Then from the gross profit, we subtract out all the other main expenses of a business called operating expenses. Everything like selling and advertising and all the admin expenses subtracted from gross profit to get something called operating income or income from operations. And this is the main area right here of our business. Everything else is peripheral, secondary, like other income, other expenses, all the way down to get the net income of our business. Okay, so make sure you know the format of this multi-step income statement. At the very top of our PD Audio income statement is the calculation of net sales, which is the gross sales for the period minus those two contra revenues, the returns and allowances we give our customers, and the discounts our customers take advantage of by paying off their bill early. Remember how we recorded this too with debits, increasing the contra revenues with debits versus revenue increase with a credit? When you combine debits together, they come out to a bigger debit balance. When you combine credits and debits together, you don't add, you take the difference. And because this credit is bigger than this debit, this net sales is a credit balance. Okay, so the next section, we're going to subtract out the cost of goods sold. And in effect, we're going to see in a few slides from now, the cost of goods sold is equal to what you start off with in your store at the beginning of the year. That's the beginning inventory, plus what you buy during the year. That's the net purchases. Purchases reduced by the returns and allowances and discounts equals net purchases, plus the freight in transportation costs, so shipping the items you have to pay for and the seller doesn't pay when you buy that merchandise. Okay, and there's two things you do with all of this. This is your costs of goods or merchandise available for sale. Either you sell it, which is this 316,000, or you don't sell it, and that's the ending inventory. So all of this calculation here can be used, and we'll see again in a few slides from now, to figure out the cost of goods sold. Net sales minus cost of goods sold equals the gross profit. Okay, so this is the first section and then the second section of our income statement for a merchandising company. The third section is now grouping all the other main expenses of your business called operating expenses. These are again the admin and the selling expenses. Subtotal and the difference between gross profit and operating expenses is equal to really a main number in your company called income from operations. So I would expect, if nothing changes for my company, I'll probably get roughly the same amount of operating income next year. So sales at the top, net sales calculation here, minus the cost of goods sold equals gross profit, minusing out the operating expenses equals net income from operations, and then you add miscellaneous revenue minus miscellaneous expenses including taxes to get our bottom line, the net income of our business. Now we've been looking at the perpetual method of cost of goods sold or inventory. Here in our chapter 5 there's a small section regarding the periodic system. Now this is covered also, periodic is also covered in the appendix, but you can ignore the appendix and just focus on this small portion within the chapter 5. What we're doing is calculating the cost of goods sold by using this formula. Your formula is the beginning inventory sitting in your store at the beginning of the period. This would be the ending inventory just one day before, but one day before was the previous year. And then to this number you're going to add the here they call it cost of goods purchased. This is all the costs of merchandise you bought during the year. Here's the cost that's already in your store or warehouse at the beginning of the year. To get this cost of goods purchased, you get your gross purchases for the year. Here's everything you bought, but there's going to be some adjustments to this. You're going to adjust it down for the returns and allowances you're going to claim from your vendor. Here you're paying off your bill early, so you're going to reduce it by the discounts you earn. And you have to pay some freight charges, not shipping to your customers, but shipping it to you, bringing it to your store. So you're adding up all this cost to get this cost of goods purchased, to which you add to the inventory cost you already have in your store at the beginning of the year to get the cost that's available for sale. Here's the maximum cost you can sell to your customers. You cannot sell more than this because you don't have more than this in your store during the year. And you don't sell everything because when you go through your store at the end of the year, you start counting. We call this a physical inventory. You count all the merchandise there. Hopefully you don't have to count too much. Hopefully you sold everything. But here we counted $40,000 of inventory left over December 31st. So of this $356,000 you did not sell, this ending inventory of 40, and you take the difference, and here is what you sold at our cost now, $316,000. So, well, let me go back a step here. That's this cost of goods sold here. Okay, here's the cost to your customers, our sales price. Here's the cost of the same merchandise at our price. And again, the difference between these two is our profit we're making. We're marking up that profit. Now, we've already reported in the previous first part of this chapter our profitability, our expenses, net income, and so forth. Now, let's evaluate how well we did. One way to do that is not just looking at the absolute dollars, but looking at a rate here, a gross profit percentage rate. The formula to get this rate is to take the gross profit. Remember, that's the net sales minusing out the cost of goods sold equals gross profit. And then we divide that gross profit dollar amount by, again, the net sales figure. And your answer is going to be some type of percentage or rate. So in the case of Walmart, here we're talking millions of dollars. So you see this 80 right here? You think that's 80 million? This is 80 billion. Here's 840 million divided by the net sales to give you a rate of 23.4%. So for every $1 Walmart sells, they're going to make a gross profit of 23.4 cents. Okay, in other words, roughly 76 cents out of every dollar is to recover the cost they have to pay their suppliers. And now the rest of this money can help them pay off the other expenses. Remember, after gross profit, we have other operating expenses. So this percentage here is kind of measuring how efficient you're earning your money compared to the cost you have to pay your vendors, your suppliers. And looks like we're doing a little bit better than the previous year. But if you compare that with Target, their competitor, Target is much more efficient in terms of earning a profit. But we all know that Walmart is bigger, right? Even though Target has a few stores here in Hawaii. But of course, they say, oh, they make it up in volume. Walmart is bigger. They make it up in volume. But if Target had the same amount of sales, their profit would not be the same. Their profit would be even bigger because they're efficient. And if you compare that to the industry, Target is better than the industry average and Walmart is below the industry average. But who do you want to be? The real big one and you make up things in volume, or here a smaller, really big, Target is big, but they run a more efficient operation? Well, let's move on to the next calculation, which is another ratio, another percentage based upon here not gross profit, but when they say profit here, they really are talking about the company's bottom line, the net income. The formula for profit margin ratio is to take that net income, remember that's sales, net sales minus cost of goods sold equals gross profit, minus operating expenses minus other expenses and income to get that bottom line net income. Now you divide it by that same net sales we saw before as the denominator of the gross profit margin. Okay, so here again Walmart, they made a net income of 11,284,000,000. We divide it by that same net sales figure, and here they come out with a percentage of 3.3. In other words, for every $1 of sales that's rung up on their cash register, how much net income does the company keep after paying off all their expenses? Not just the cost being paid to the vendor, but all of the operating expenses and other expenses like taxes. Well, what hits the bottom line is only a little over 3 cents. Gee, when I pay my money to Walmart, they're not making $1 profit for every dollar I'm giving them. What they get to keep and maybe pay out as a dividend to their shareholders is only 3 cents. And even then, if they want the company to grow, they're not going to pay out that 3 cents to their shareholders. They're going to keep most of it. Target is a little bit more efficient. The industry is a little bit more efficient. Again, so-called Walmart makes it up in volume. And they have less efficiency than the previous year. That's kind of telling me they probably have more operating expenses overall here versus here. Here's another ratio percentage that I'm not going to get into because it talks about operating activities, and we'll see operating activities really cash flow in our last chapter of the semester, but we divide that by net income to get how efficient we're collecting our money as compared to the profitability. And they have some rule of thumbs here regarding whether the ratio is less than 1 or greater than 1. Our appendix at the end of our chapter deals with that periodic systems. You only have to be responsible for what's covered within the chapter, and you can forget about the debit and credit journalizing of the periodic method in the appendix. Okay, so you take a look at the videos for the brief exercises. Select some selected brief exercises for chapter 5.